The 52-week high and low. 52 weeks, as you know, is a year. This is basically the highest price and the lowest price over the last year. This is quite a common indicator, a common thing that you find in most of these share quote sheets, and it's important because what it gives you is an idea as to just what the shares range has been for the last year. But often you find that if your current price is quite close to the high or the low for that share, it's a significant event. It might be something that could form resistance or support for a particular share. So if a share is really low, as in the 52-week low, it could provide some kind of support because some people might believe it's fallen enough, etc., etc. Likewise, if it's a 52-week high, again, you'd find that some people believing that it's probably going to form resistance there or have some resistance trying to break through that particular level. Another important indicator given to you on that share sheet would be volume. Now, for technical traders out there, you've heard the term that without volume, without actual number of shares being traded, you don't actually know how important or significant a particular move is. Volume describes basically how many shares were traded on that particular day. So for Kumba, it might be multiple millions. For some of the smaller shares out there, it could be a few tens of thousands, a few thousands in some cases. Now, what volume gives you is a measure of liquidity. Now, liquidity, you've heard this term before, I'm liquid, I mean liquid, blah, blah, blah. In terms of the stock market, liquidity means the following. Liquidity is how easy it is for you to enter or exit a trade. What do I mean by that? Let's just say there's a share out there that you want to buy into. You want to buy 1 million rounds of that share. If not much or not many shares trade in a particular day, maybe just 100,000 on average trade. If you go in with your 1 million rounds, you're going to be basically buying 10 times more than the average traded volume for that day. It's like going to basically the lady selling guavas on the side of the street and trying to buy all of guavas in one bundle. In all likelihood, you're going to change the price of those guavas. If, however, you have a much larger share, much more liquid share, imagine a share like SAB or MTN that trades hundreds of millions of rounds a day. Your 1 million rounds is basically less than 1% of the total volume traded in a day. And therefore, you could easily go and buy, quite a large quantity of that particular share without having an ability or without having an impact on the price of that share. The general rule is highly liquid shares have higher trading volumes. I would suggest for people that are looking to trade or even to invest, liquidity is an important measure to take into account because sometimes you might find yourself in a position where you have a share and you want to get out of it, but you may have made a huge profit in the share as it's gone up and up in price. But when you want to get out of it, you're getting out in such a way that the actual act of you selling that particular share drives that price down significantly, and you aren't able to take all your profits out. Try and stick with shares that have quite significant liquidity, and don't go for shares unless you're a very wealthy individual in which you are the largest trade for the particular day. It generally indicates a low level of liquidity compared to what you want to do with that share. Another important indicator, another important number given to you on shares is the dividend yield. It's simply the dividends that you get per share divided by the share price times 100. Often you'll find that some shares don't give a dividend, therefore there'll be no dividend yield. And usually the indicator here is the higher the better. You want a large dividend coming out. It's like basically the earnings that the company makes that they give on to you. So some cases, especially if you're looking towards retirement, getting income, you want a higher dividend yield. Higher dividend yield stocks are very good. In fact, just choosing high dividend yields as one of the criteria for your investments tends to put you towards better quality, more stable stocks, lower risk stocks. Reason is quite simple. If a company can pay a dividend, it generally is a higher quality company compared to companies that may not be able to pay a dividend. There are obviously exceptions. The most notable exception until quite recently was Apple. While Steve Jobs was alive, he was never willing to actually pay a dividend, believing that he could always do better or do more good with that money than the average investor could. Since he's passed away, we've seen more and more pressure on the company to pay out dividends. So it's an indicator, like I mentioned, of health of a company, but just because there's no dividends does not mean that you would look towards a company without dividends as being, by definition, a bad company. It's just that generally you'll find companies that pay more dividends are better than companies that pay less dividends, with exceptions. Another term to learn about is special dividends. Sometimes a company will do something big. For instance, when Telkom got rid of Vodacom, its Vodacom shares, what happened was it was bought out by Vodafone. So it got a huge profit from that particular transaction and paid a special dividend to the shareholders. Why? Because the transaction was so large that the company was suddenly left with a huge amount of money, It did not know exactly what to do with all that money, so it decided some of the money, if you can't do anything with the money, it should return it to shareholders, and it was done by a special dividend. Generally, a company should always have an investment goal for its money. It shouldn't just be stocking up money for the hell of it. If the money is not being used for anything or doesn't have a future purpose, it generally is best for the company to return those monies to the shareholders.